Hello, my name's Neil Alexander and I'm the CEO here at Nutmeg. I'd like to welcome you to December 2020's Investor Update. It's certainly been a challenging year and we hope you're all safe and well, and our thoughts go out to those who've been affected by the pandemic and who've been working on the front line against the pandemic. I'm joined today by James McManus, our CIO, of course at a suitable distance. Welcome, James.
Hi, Neil.
Now is an appropriate time to say a huge thank you to all of you, our clients, who've trusted us to manage your investments. We're now helping over 100,000 investors in the UK to achieve their financial goals by managing over £2.5 billion. Thank you. Despite the unusual circumstances, and with the Nutmeg team working remotely for most of the year, I've been incredibly proud of what we've been able to achieve, develop and deliver for our clients. At the start of the year, we launched our Junior ISA, allowing you to invest up to £9,000 for the children in your lives every year up to the age of 18. And as always, we've made sure you have a choice of investment styles and risk levels. Thanks to a key partnership with JP Morgan Asset Management, we've also launched Smart Alpha Portfolios, bringing the expertise and research of one of the world's leading investment houses to a new Nutmeg investment style, available on all of our ISA products with pensions to follow soon. We've also rolled out partnerships with Yolt, Emma, Starling Bank and Money Dashboard to make Nutmeg as accessible as possible for clients, and we continue to improve your wealth management service. And we became the first wealth manager in the UK to enable open banking payments, meaning you can top up your investments from your mobile in just a few taps. And Apple users can now see their Nutmeg investments and the latest views from the investment team on their home screen, thanks to the recently launched iOS widgets. It's been a positive year for us despite everything, and we're really looking forward to 2021. So let me pass to James now for our investor update. So James, first up, does the news about the 3 potential COVID vaccines mark an upward turn for the economy?
Well, if you remember back to March and the worst of the market volatility, we were talking about the 3 response functions we really needed to the crisis, and that was the health response function, the monetary response function and the fiscal response function. And November's positive vaccine news really delivered the news that the world had been waiting for, and that was a boon for global equity markets. So global equity markets had their second best ever month in November, their second best since 1969, led by European equity markets. A really strong month for European equities, up 17.1%, but in a month where most developed stock markets delivered double-digit returns. Now, emerging markets, they lagged the developed markets, returns of just under 8% for the month, but it was really the small caps, both in Europe and the US, where we saw phenomenal performance on the month, and that really reflects the importance of economic normalization to smaller companies in the economy. Now, does that mean we're back on a rapid path to normalization? I think it would be pretty foolish to say so, but what it does mean is there's potentially light at the end of the tunnel. And at the worst case here, we're talking about a vaccine news that could potentially reduce the need for activity restrictions, those restrictions that are so damaging to Western economies. Now, near term, clearly there are challenges, formidable ones in the context of bringing the health crisis under control, but also logistical ones in being able to roll out a vaccine more widely in society. But alongside a global economic recovery that has seemingly found its feet in recent months, we're cautiously optimistic that the worst is now behind us, and that's really what's been reflected in financial markets in the month of November.
Well, thanks, James. And some cautious optimism feels apt as we're coming into the Brexit endgame. But I mean, is the potential news of a deal being spiked by some pretty challenging data on the UK economy?
Well, it's no secret that the UK has suffered the most amongst the G7 economies on the back of COVID, partly because of such a large service sector within the economy. And actually, the UK could now experience a double dip recession, as we've seen some of the high frequency economic data take another dip as this most recent lockdown has come into force. But we've also seen policymakers continue to enact policy to support the economy. That, of course, increases borrowing as well, and we've seen the UK government's deficit reach a record in the past month or so. But there are pockets of brightness alongside the labour market woes. The UK housing data remains very strong, and actually we have to remember that this isn't an ordinary recession. It's a temporary halt of activity, and as we see the economy come out of its most recent lockdown, we should hopefully see a turn in that data again as business and consumer confidence improves. On the Brexit front, I think we are now finally in an end game, and I think maybe even our viewers will know what that end game is by the time that they're watching this video. But I think no matter what type of Brexit is delivered in the end, the buyer's strike that's been in place from foreign investors on UK assets will take some time to repair itself. That confidence will take some time to be rebuilt. Now, there are certainly attractive aspects to the UK market, not least its comparative valuation and also the potential for the pound sterling to appreciate in the light of a deal. But there are other factors to consider too. The sector mix of the UK market, whether we will see that all-important dividend recovery come through. And also it's important to recognise that a lot of the large cap UK stocks rely on overseas revenue as a source of their profitability, and any rise in sterling potentially is a headwind to that profitability.
Well, thanks, James. And of course, the other big news in November, and dare I say rolling into December, is the US election. Quite long running, but it seems like it's about to be concluded. And I know it's something that yourself and the investment team kept a very close eye on, bearing in mind the positions on US equities. So could you share with us your perspective on a Biden White House?
That's right. With the vaccine news flow coming so quick after the US election result, it's easy to forget that going into November, the US election was actually really the focal point for markets in the month. And the result as it stands is a positive one for markets, or at least it has been interpreted as being positive. A more stable, predictable leadership style coupled with a restraint on the legislative agenda for the Democrats, so a restraint on their ability to enact some of those less business-friendly policies such as tax rises. But the race, of course, isn't over, and I think there's a really key race in January that is still to be decided. That's the Senate, where 2 seats will go to a runoff election on January 5th. Why is that so critical? Well, if the Democrats were to take both of those seats, that would tie the Senate at 50 seats for the Republicans, 50 seats for the Democrats, and under the US Constitution, that hands the deciding vote to the Vice President, Kamala Harris, and allows the Democrats to enact their legislative agenda. What do we expect from a Biden presidency? Well, I think firstly, a more progressive approach to tackling some of the COVID issues in the US, and as I mentioned before, a more predictable diplomatic leadership style. We also expect a heavy investment into the clean energy sector. You know, Biden has been very clear about his views on climate policy, and we're expecting Biden to enact a large infrastructure spend in the clean energy sector to really make sure that the US's energy dependence can be sustained in the decades ahead. Away from those two aspects, fiscal spending is likely to come through as Biden looks to support the economic recovery. And we also expect the thorny issue of China-US trade not to go away, but to be approached with a more diplomatic and potentially more coordinated approach with European partners.
Well, thanks, James. That was fascinating insight. And expanding on that, could you tell us where you're looking for positivity in 2021 following such a tumultuous 2020?
Absolutely. So without getting too excited about vaccines and the possibility of a rapid normalization of life and economies in 2021, I think there are still lots of reasons to be positive. And when we look across the global economy, clearly there is still much healing that needs to take place. But actually, there is also evidence of the early stages of a self-sustained recovery. We're seeing real momentum in global manufacturing data. We're seeing a sustained recovery in consumer and business confidence as labour markets improve. And in fact, we're even seeing some bright spots in the investment picture. Within that, wider sort of healing process, there are some really bright spots for economic data. You know, the US housing market would be an example, to pick just one, where we're seeing a continued robustness in the data as it comes through. And I think it's easy to forget that in 2020, we've pumped record levels of monetary and fiscal stimulus into the economy. And so as we come off the lows of activity and the lows of confidence, actually all the ingredients are there for an economic recovery to take hold and to flourish. Now, that will naturally favour high growth assets such as the emerging markets. But at Nutmeg, as well as having a more constructive view on emerging markets going into 2021, We also retain that constructive view about the US economy, incredibly flexible economy in itself, and that should really give it a position of strength as we continue to sail through these uncharted waters.
Great. Okay. Thanks, James. And as we know, investing is always for the long term. But even so, I'm sure our clients would like to know, how have the fully managed Nutmeg portfolios performed this month?
Well, given it was such a strong month for equity market returns, it was also a very strong month for Nutmeg portfolio returns. In fact, our average Nutmeg client portfolio delivered its best ever monthly returns in November 2020. That meant returns ranging from around 2% in the lowest risk portfolios through to around 10% in the highest risk portfolios.
So given the large market movements in November, have you made any changes to the Nutmeg fully managed portfolios?
Well, we did make a number of changes to the fully managed portfolios through the month of November, largely due to the timing of gains and losses in equity markets. So firstly, at the beginning of the month, we actually rebalanced our equity exposure following a poor end to the month in October, where our equity markets had drifted lower, to make sure that we were carrying the right amount of risk in portfolios into the US election. And then actually in the middle of the month, we rebalanced portfolios again, trimming some of that equity position that had grown extensively with the month's strong equity performance in order to keep the risk balanced in our portfolios. And that included adding to holdings in US small cap and also in the clean energy sector. And it's slightly unusual for us to rebalance twice within a month, but then again, November was a very unusual month for investment markets.
Okay, thanks, James. So our last question comes from Jason J on YouTube, who, following our last investor check-in, wanted to ask the following question. With the shift of the centre of economic activity towards Asia, will Nutmeg then look to rebalance for a somewhat heavier allocation towards Asia?
Thanks for the question. Well, as you might have guessed from my earlier comments, we are quite constructive on the outlook for emerging markets going into 2021. And that's on the back of a sustained activity recovery in emerging Asia as the global trade recovery continues. And when we look at emerging market Asia, what we see is that economies have generally been able to stave off the effects of a second wave of COVID. And that's really put them at a competitive advantage in terms of the stage of their recovery relative to some of their Western counterparts. But they also have a large technology sector within the stock market indices. And we think those stocks are set to continue to benefit from what is a secular trend in digitalization. But we shouldn't forget that emerging Asian economies are export-focused economies, and that means they need buyers of their product. And that's something that lockdowns in the West can clearly affect. But we think with a self-sustaining recovery in its early stages, that's actually a real positive for Asian emerging market economies, and therefore we continue to hold that constructive view into 2021. That doesn't mean we're ruling out their Latin American counterparts, far from it. They've struggled this year, particularly with the worst of the health crises, but also as commodity export nations, they stand to benefit as commodity prices rise more broadly alongside a global trade recovery.
James, thank you very much for that update. It has certainly been an interesting year.
Thanks, Neil.
And as always, if you've got questions for James and the investment team, you can contact us through social media, in the comments section below this video, or by email. If you'd like to learn more about investing with Nutmeg, our client services team are there for you. We'd like to wish you the very best for the festive season. Stay safe, get outside, get some fresh air, and we wish you all the best for the new year. Thank you for watching.